So today is May 18th, 2017, and I'm going to commit some time today to discussing the overall condition of the United States real estate market. Now, many of you may recall rather palpably the housing bust from what has already been roughly a decade ago. Of course, the bust lasted a number of years, reaching its inflection point no more than 5 years ago. So many people out there, experts and novices alike, feel they have a strong handle on the forces which caused the crisis. Some out there have seen The Big Short, I'm sure, and they have likely gathered enough information to arrive at some of their own conclusions about the market, what caused the irrational exuberance, and who was chiefly responsible for the ensuing financial disaster. So I'll be one of the few contrarians out there to tell you that your conclusions are probably obtuse, short-sighted, or wildly incomplete, though maybe not entirely off base. I suppose we'll find out. Now, in order to better understand the impetus for the boom which ensued during the early 21st century, we'll need to first journey back in time to an epoch of historic economic disrepair, the Great Depression of the 1930s. Now, many people don't know this, but the Great Depression actually became great roughly 4 years after the stock market crash of 1929. What eludes most surveyors of the crash is the fact that government expenditures actually increased dramatically following the crash of '29, when President Herbert Hoover increased the federal budget from $3.1 billion to $4.7 billion in 1932. What's more, Hoover actually inherited a sizable budget surplus, only to transform it into a deficit of $2.7 billion, the third largest budget deficit in United States history. This meant an increase of the federal government's share of the whole economy, which constituted a mere 3.4% of gross domestic product beforehand, only to increase to 8% of GDP during the Hoover administration. Now, GDP is the principal metric by which governments assess their nation's overall economic health. It is the sum of consumer spending, investment, government expenditures, and net exports. Of course, this metric became an essential tool for governments to justify not only the efficacy of government spending, which occurs only through the expropriation of capital from producers and at the expense of otherwise viable investments, but also the capacity of governments to take on debt against their anticipated future revenues. So here we have a flawed metric for the bird's eye evaluation of economic well-being, and thus a failed philosophical attitude toward the appropriate means to resolving economic disrepair. Now, the disrepair of an economy proves always an excellent tool for the wielders of government policy. You see, these are the principal agents of theft who must necessarily convince the public to plunder itself into oblivion while doing it quasi-democratically. So the government, the institution that shall never let any crisis or disaster go to waste, is always inclined to propose a myriad of tax-sponsored, government-centric solutions to a problem it ill understands. These are projects typically fueled by sound intentions but untested and impractical methods. So in the aftermath of the crash of '29, the United States would see the introduction of a protectionist tariff, known as the Smoot-Hawley tariff in 1930, the first federal minimum wage or prevailing wage legislation known as the Davis-Bacon Act of 1931, the later Union-serving Wagner Act of 1935, the economically expensive Fair Labor Standards Act of 1938, the National Recovery Administration of 1933, the unsustainable Ponzi scheme known as the Social Security Act in 1935, make-work job creation efforts like the Civil Works Administration and the Tennessee Valley Authority in 1933, the moral hazard-inducing 1933 Banking Act, which established the Federal Deposit Insurance Corporation, government-sponsored enterprise Fannie Mae in 1938, which introduced the federal government to the secondary mortgage market, and the 1934 Federal Housing Administration, whose principal objective thus became the introduction of home ownership as the American dream. This would later combine with easy monetary policy, low interest rates, induced tax sheltering through home ownership, and securitized mortgages or mortgage-backed securities bought up by federally insured Fannie Mae and the later introduced GSE partner Freddie Mac to spark the nationwide disaster later known as the housing crisis. So, in pursuit of well intentioned public policy, Hoover and Roosevelt inadvertently extended the post 29 market correction by preventing a market reallocation of resources, by imposing an artificial price floor on the costs of labor and unintentionally limiting the free exercise of labor, employment, and contracts, by preventing an equilibrium of exchange with international producers with comparative advantage, by then driving up the price of goods and commodities by artificially increasing the price of otherwise more affordable goods, and worst of all of this set the precedent for future generations' acceptance of the role of government, the nature of wealth creation and intelligent design, and the believed role of government in addressing market maladies which are appropriate from time to time to purge the markets of ill-advised investments and speculation. So the administrations in charge have perpetually sold to the public the fantastical notions of easy fixes through stimulative monetary policies and job creation. The unenlightened majority might accept this narrative, but the shrewd economist will see right through it. As it turns out, as badly as the modern American wants to believe that there's an easy fix or a way to wash our hands of the previous bouts of irrational exuberance, there plainly is not. Americans speculated heavily on dot-coms when lower interest rates implicitly encouraged investors hungry for returns to dismiss value, profits, and dividends to simply pursue growth and stock price appreciation. As these companies continued to fail to post profits and buyers became sellers, the information technology bubble popped and left the federal government with a mess that they would hastily translate into the next government initiative, engineering the greatest wealth effect in American history through the subsidization of the so-called American dream, home ownership. Unfortunately, in pursuit of this fun-filled escapade of euphoric proportions, buyers forgot that home prices are a function of rents. Economists neglected to remember that homes don't actually produce any workable wealth, that they cannot be the principal revenue generator for an entire economy. Unfortunately, all of this eluded the pundits and laymen alike. Too many people were mesmerized by the illusory prospect of riches to remember the pragmatics, and anyone who suggested the opposite was relegated to the rank of buzzkill or pessimist. So now, after the dust seems to have settled on the financial crisis, and bureaucrats are talking heads are boasting of a possible recovery, how does the United States real estate market really look? In a nutshell, it is still devastatingly weak, and the latest figures portend another major correction in real terms, not necessarily dollar-denominated terms. So after the financial woes caused by the bursting of the housing bubble, the United States and the Federal Reserve embarked upon several bouts of quantitative easing, a euphemism otherwise known as inflationary policy, whereby the Federal Reserve unprecedentedly brought interest rates to zero and bought up billions of dollars of U.S. treasuries and mortgage-backed securities to afford liquidity to the market and to artificially buoy these asset prices to generate that aforementioned wealth effect to inspire confidence in the American consumer, to then encourage further spending by way of borrowing against the equity in one's home to finance consumption or investment. It is by no surprise or no mere coincidence that the median home price of most metropolitan areas in the United States has steadily, even dramatically climbed, at least in nominal terms, since the introduction of these policies. And just as the previous dot-com bubble was unjustified by profits or dividends, and just as the previous housing bubble was unwarranted in terms of creditworthiness or incomes, the present circumstances are different only by magnitude and by the underlying diminished quality of the next generation of investors on whom these stratospheric valuations depend. Of course, the data on this demographic is dismal at best. So I've read a recent consumer trends report for 2016, which reflects that almost a third of home buyers today use more than one source for their down payment, including gifts and loans from family, selling stocks and bonds, and cashing in retirement savings. Clearly, this generation, the millennial crowd, is deeply encumbered by loads of debt obligations that weren't nearly as prevalent for their predecessors in Generation X and the baby boomer generation. I'm confident that demographics, financial literacy, and emerging trends in the way money is being managed will prove tremendously impactful in the future pricing of homes and the sustainability of the current nominal rally. And as baby boomers and Generation X, the latter of which constitutes 38% of all sellers, begin to realize their profits by continuing to turn into sellers, I'm wondering how much buyer volume will be there to justify their assumed valuations, especially considering the total weight of debt shouldered by that anemic class of up-and-coming homebuyers and their propensity to move back in with their parents. And according to recent research, the median age for first-time homebuyers has remained virtually unchanged for the past 40 years. In 2015, it was 31 years old, compared with 30.6 years of age in 1970 to 1974. Of course, the median in this data set fails to reflect the volume of purchases and the character of the households and their changes over time. Of course, the modern household benefits from dual incomes, whereas the American household up until the early to mid 1970s still relied on a single income, when the female labor force participation rate was still around 50%. So millennial couples are, on balance, struggling to achieve in tandem what their predecessors attained with a single income source. What's more, the home ownership rate was actually higher then than it is now. Now, the research also shows that 2/3 of millennials haven't reached that home buying age of 31, and 22% are under 25 years old. Now, I think that may be indicative of the future shift for expectations around that pivotal moment when the millennial generation is the principal home buyer and renter. And while millennials are expected to form 20 million new households by 2025, the median annual income of those millennials older than 25 is a mere $38,220. And according to the Harvard Joint Center for Housing Studies, over half of households in their 20s and 30s with student loan debt in 2013 did not have four-year college degrees. So in total, we have a burgeoning demographic of graduates and non-graduates with enormous student loan debts who have no credible skills or training, some having no degrees at all to show for those debt loads, and some of those who are ostensibly the hope for the propped up and highly leveraged real estate market. Now, how can this generation fill this role while it's already largely leveraged on so much untenable debt, so little potential for professional growth, and no savings to speak of? I've also read some research where the author claims that these debt loads invariably bear an impact on home ownership, but that it may not be as pronounced as we think. Now, of course, I'd agree with the final sentiment, suggesting that we may in fact exaggerate the incidence of renting versus home ownership among millennials, but I do believe that the intuitive sense of this is correct in assuming that millennials are less prepared for home ownership than their counterparts of previous generations. Unfortunately, a comparison between their outstanding debt obligations to their home buying practices suggests a mismanagement of priorities and unwitting speculation on an asset whose value is not at all guaranteed to appreciate. Unfortunately, most of this resides in untested, unprecedented territory, and whatever the future has in store, it will surely be a palpable reminder of the value of real work and production over illusory financial wizardry.